Were you expecting shark fins? What's glittering more than anything else in the world today? My favorite metal. We're talking gold, like Treasure Share Madre gold, like Cramer Idol Auric Goldfinger gold. And we're going to the charts, after all, it is chart week, to figure out if this remarkable September march to almost 1,300 is over, and whether we should now slaughter the fatted gold calf, or is 1,400 in the cards, or in the charts for that matter. You know I think that gold normally runs to $2,000. It's been my mantra since I started the show. And I think you should own the GLD ETF or gold stocks, so like Agnico Eagle or gold coins or the bullion itself. But I want to go to a teacher, an educator, who uses charts to force you to imagine what can happen based on what has happened. We're going to examine gold by talking to someone I consider to be a very compelling figure, a man who challenges conventional thinking. I'm talking about John Roque. He's the managing director at WJB Capital, where he heads the technical analysis strategy group. He's also an old friend whose work I have followed for many, many years. Roque is one of the smartest guys around, and I like the way he approaches the technicals. He uses long-term trends to buttress his arguments. That's why I want to give you a chance to see how he operates, and maybe you can think like him by looking at the relationship between gold and the S&P 500. It's a much-needed lesson on chart relations. John, welcome to Mad Money.
Hi, Jim.
It is good to see you, partner.
Good to see you, too.
Really good. You have taught me so much, so let's go to work. You know what? I usually don't do this. It's your airplane, or it's your telestrator. Let's take a look at what you're thinking here.
Okay, so what we have here, Jim, is a relative ratio, a fraction, where we divide gold by the price of the S&P. We take it back over 80 years, 1928 to the present. So we have 3 prior advances.
Okay.
So in the early 30s to the early 40s, gold got to roughly 4 to 4.5 times the price of the S&P.
Okay, so this is a ratio. People shouldn't look at this and say $400. This is a ratio to stocks.
Right. So gold relative to the S&P, gold was 4 to 4.5 times the price of the S&P.
Okay, got it.
Then we have the second run where gold went to roughly almost 3 times the price of the S&P, actually 2.7 times.
All right, now help me out. People might say, well, hold on, what the S&P, what kind of, how does that mean? What price is the S&P? You mean, like at 11,100, that kind of thing?
Well, let's just make it easy on my math.
Okay.
If the S&P stays at 1,000, the long-term average for here is 1.5. But we know that we have to get above the long-term average to create the long-term average.
Got it.
So if this number got to 3 and the S&P was at 1,000, gold gets to 3,000.
Really?
Yeah, that's the way this ratio works.
Really?
Yeah.
I mean, we're almost at 1,300.
1,300, right.
You're telling me that these ratios, the history, says that we could go almost 3 times higher.
Well, I don't want to be hyperbolic here, but pick a number. It is above where we are here.
2,000 is not a bubble, according to this.
No, it's not. And in fact, 1.5 times is the long-term average. And people think we're in a reversion to the mean business.
Right.
Not a reversion to the mean business. Reversion beyond the mean business. So I think you have to get above this long-term average of 1.5. And here, Jim, if you go back to this period, gold was actually 6 times the price of the S&P.
Okay, well, now people might say, John, what happened in this period and what happened in this period that may be different from now? So that it's...
Right, all the periods are different. Okay, this was a deflationary period, right? And there was an international gold standard.
Okay.
And we had the Great Depression. So gold was essentially fixed, but the S&P collapsed, which we all know.
Oh, okay. So in that case, gold holds its value.
Correct.
Stocks go down.
Correct.
Okay,
and people think this can't happen because rates are so low now. But in 1945, the 10-year Treasury yield was 1.67%.
Oh,
it can happen like that.
It can happen.
Okay?
Right. Okay.
Then you had a period here which was fraught with inflation, higher oil prices. Not so much different than now where we have high commodity prices.
Right.
The official figures don't show any real inflation yet, but the high commodity prices are telling you something's going on.
Right.
And then, of course, here you had what led into what was the Iran-Iraq war, and then finally it peaked.
So this peak, what happened that day?
The peak here was roughly around the time of the Soviet invasion of Afghanistan.
Really?
Yeah, right around this period here. But I guess investors must have said that's as bad as it's going to get right here. Also in the early 80s, the S&P was selling at a single-digit multiple, which we don't have yet.
Right. Okay, now, let's think about it like this. What happens if someone says, I'm listening to this guy, Roque, didn't he just say that gold went high during deflation? And then he comes back and says gold went high during inflation. Well, which is which? How could it be both?
It is kind of weird here that gold can seemingly benefit from all inputs.
Right.
But it's been right not to sell gold since 2001. It's been right to continue to give it the benefit of doubt through all of these sort of various inputs, potential inflation, potential deflation, potential sovereign debt risk, potential currency risk. We think that gold will ultimately get to a higher level relative to the S&P when the next crisis hits. maybe it's a dollar crisis. We're just not there yet.
Well, you know, you made me think, Afghanistan, Russia, could this be, are people thinking about Iran, the United States?
I leave that to guys like you to conceptualize in that regard. But the trend says that you should be sticking with gold here and have it as a part of your portfolio.
I agree with that. I think at least 10%. Now, here's another thing people want to know. They are worried that they missed it. They also think that, you know, maybe it's going to take years to get there. Give me some time frames and tell me whether I would, if I bought gold tomorrow, how do you think I'd do?
I think you're going to do fine. Just consider it like this. Newmont Mining is really just breaking out right now. The gold stocks really haven't participated to a great degree.
Okay, so let's just sum it up. No bubble.
No bubble.
Has been more expensive at other times.
Correct.
Lots of room to go up.
Correct.
Theoretically could even go to 3,000 and not be overvalued versus what it's done before.
Jim, the numbers to the upside can be ridiculous. I don't want to get into them now, but let's just say 3,000 is not a crazy number.
And my $2,000 price target is not a bubble.
Not a crazy number. And Jim, just one more thing I'd like to add. I've heard a lot of talk that gold might be in a bubble.
Yes.
I don't think so. Bubbles are born out of greed, not fear. This is going up because of fear.
John Roque, I feel so much better.